Did you know the top 1% in America holds more wealth than the entire bottom 90%? It sounds unbelievable, but it's a reality, and the gap is widening. This isn't just about fairness, it's about understanding the fundamental forces shaping our economy and your financial future. In this video, we're going to break down the wealth gap, why it exists, how it's grown, and what factors are accelerating it. We'll explore the mechanisms that allow wealth to concentrate at the top, from asset appreciation to tax policies, and we'll look at how these trends impact everyone. By the end of this video, you'll understand exactly how the rich keep getting richer, and what, if anything, can be done about it. Let's start with a historical perspective. For much of the 20th century, income and wealth were distributed more evenly than they are today. Post-World War II, strong unions, progressive taxation, and robust economic growth created a period of shared prosperity. However, starting in the 1980s, things began to shift dramatically. Tax rates for the highest earners were slashed, financial deregulation took hold, and globalization accelerated. This shift wasn't accidental. Policies favored capital over labor, meaning profits from investments were taxed at a lower rate than income from wages. Consider this: between 1980 and 2018, the top 1%'s share of national income nearly tripled, rising from 8.9% to 24.9%. This isn't simply people working harder, it's a systemic change in how wealth is created and distributed. Think of it like a game of Monopoly. If one player starts with significantly more money and gets preferential rules, they're almost guaranteed to win. But here's where it gets interesting: it's not just about income. Wealth, which includes assets like stocks, bonds, and real estate, is where the real disparity lies. And a huge driver of wealth accumulation is asset appreciation, the increase in value of those assets over time. Since the 1980s, asset prices, particularly stocks and real estate, have soared, benefiting those who already own them. For example, the S&P 500 has increased over 10,000% since 1980. While wages have stagnated for many, those with significant investments have seen their wealth multiply exponentially. This creates a feedback loop: more wealth leads to more investment, which leads to even more wealth. It's like compound interest, but on a massive scale, and only accessible to those who already have a substantial principal. Another critical factor is access to opportunity. Wealthy individuals often have access to better education, healthcare, and networks, giving them a significant advantage in the labor market and in starting businesses. They can afford to take risks, invest in their skills, and navigate complex financial systems. This isn't about individual merit, it's about the advantages conferred by inherited wealth and privilege. Consider the difference between a child growing up in a wealthy suburb with excellent schools and a child growing up in a disadvantaged neighborhood with underfunded schools. The opportunities available to each child are vastly different, regardless of their inherent talent or potential. It's a structural inequality that perpetuates itself across generations. But it's not just about inherited wealth. The financial industry itself plays a role. Complex financial products and strategies, often available only to the wealthy, can generate significant returns. Private equity, hedge funds, and venture capital offer opportunities for high-growth investments, but they require substantial capital and expertise to access. In 2021, private equity firms held over $8 trillion in assets. These firms often employ sophisticated tax strategies that further amplify their returns, contributing to the concentration of wealth. It's a system where those with the resources can leverage those resources to generate even more resources, creating a widening chasm between the haves and have-nots. Now, let's talk about tax policy. Progressive tax systems, where higher earners pay a larger percentage of their income in taxes, historically helped to redistribute wealth. However, over the past several decades, tax rates for the wealthy have been significantly reduced, while loopholes and deductions have proliferated. Capital gains, the profits from selling assets, are taxed at a lower rate than ordinary income, benefiting those who derive most of their income from investments. The Tax Cuts and Jobs Act of 2017, for instance, significantly lowered the corporate tax rate and provided substantial tax breaks for wealthy individuals and corporations. According to the Congressional Budget Office, this legislation added trillions to the national debt and disproportionately benefited the top 1%. This demonstrates how policy choices directly impact wealth distribution. So, what's the climax of all this? The wealth gap isn't a natural phenomenon, it's a consequence of deliberate policy choices and systemic factors. It's a self-reinforcing cycle where wealth begets wealth, and opportunity is increasingly concentrated at the top. This isn't just a moral issue, it has profound economic consequences. Extreme wealth inequality can lead to decreased economic growth, social unrest, and political instability. A healthy economy requires a broad-based distribution of wealth, where everyone has the opportunity to participate and benefit from economic progress. When wealth is concentrated in the hands of a few, it stifles innovation, reduces consumer demand, and undermines the foundations of a democratic society. The current trajectory isn't sustainable, and addressing it requires a fundamental rethinking of our economic and political systems. If you want to learn more about building wealth and navigating the financial landscape, check out our video on Next Video Topic. It dives deep into brief description of next video. Understanding these forces is the first step towards securing your own financial future and advocating for a more equitable economic system. The wealth gap isn't inevitable, it's a challenge we can address, but only if we understand the underlying dynamics at play.